Today is Sunday, July 30. This is a recap for the stock market activities last week and an outlook for the week to come. And folks, I got a good one for you tonight. It's going to be a long one, so buckle up your seatbelts. And folks, we are now in an era of mass delusion. Folks are looking at the economy and saying, oh, maybe we're going to head to expansion now. Forget about the recession. The recession is not going to happen. Meanwhile, the reality of this economy is a massive ticking nuclear bomb that is waiting to be detonated. And it all revolves around the icy hot phenomenon in this economy. See, when the Fed realized, finally, they wake up from the coma and realized that inflation is not transitory, they decided to hike interest rates higher. But they've been so cowardly in their approach. You see, back in the late 70s and early 80s, when Chairman Volcker was in charge, he defeated inflation by jacking up interest rates dramatically higher, way above the inflation rate, causing not just one recession, but two recessions. And he got the job done. But this Federal Reserve, they want their cake and they want to eat it too. They want to take inflation down, but somehow not create a recession in the economy. And by doing so, they're going to give us both the second wave of inflation and the most devastating recession that we have seen this century so far. And the reason is by following this so-called data-dependent approach of being too weak in raising interest rates to tackle inflation down, all what they've done is split the economy into the icy hot phenomenon. Sectors that are already in a recession right now, some would argue, and those are in the icy. Others remain in the hot category. They continue to keep inflation higher for longer. As the Fed looks at the statistical updates of the CPI, aka the CPLI, they look around and say, mission accomplished. The CPI went down from 9 to 3% because of the statistical formulas. Mission accomplished. So we're going to pause. We're not going to raise interest rates anymore, or we're going to be data dependent. In doing so, categories from the IC will start to move back into the hot, as we're seeing in commodities, for example, and we will see the second wave of inflation. The Fed will panic, and they will start to raise rates aggressively again. And what will happen is, for the mission to be accomplished at this point, is to move the hot categories into the icy. But in adding this pressure, they're going to move some of these icy categories into implosion. And many are speculating that this category in the icy would be commercial real estate, which is very icy right now. Not as icy as Mitch McConnell, of course. I don't know if you saw that or not. This week, your beloved senile leaders, they're freezing all of a sudden. There's a glitch. Just imagine being Xi Jinping or Vladimir Putin, and you're looking at this. What are you going to say? You know what? We don't have to do anything here. This country is collapsing from within. All we have to do is just grab the popcorn and watch the shit show.
Priorities submitted.
Yeah, just say aye.
Okay, just aye.
Thank you.
Poor kids are just as bright and just as talented as white kids.
But your beloved senile leaders are not just in charge of your domestic policies, international policies, but also your economic policies, led by the Federal Reserve, and none other than Chairman Powell, the worst chairman in history, who now says that, recession is not going to happen anymore. And they're selling this fantasy to the public that everything is okay, you gotta put your blindfolds on, don't hear anything, any of the warnings, the concerns, the signs that you see right before your eyes. Put your blindfolds on, put your noise-canceling headphones on, and keep marching to the slaughter. Keep buying the stock market, keep taking risk in the economy, everything will be fine. To the point where we see that after this insane bear market rally, this bubble that we're seeing in the stock market right now, specifically in the NASDAQ, one would think, hey, maybe I need some protection here. Maybe I need some hedging here. Nope, nobody wants any hedging anymore. And the reason is the Fed, the administration, they sold the public the fantasy. Buying the NASDAQ right now with no hedging is just like banging a Cincinnati hooker with no condom. STDs are the least of your concern. We're talking about the Great Plague here. And we know that this is all an unloading operation. The oligarchy, the Wall Streeters, they got caught by surprise in 22. They thought, oh, inflation is transitory. It's not going to matter anymore. They forgot to sell. Stock market goes down. They manufacture all of these bear market rallies. Most famous one was last summer, but they all failed. And they need to unload. They need to get back to even to the highs and unload it to somebody else. This year, they figured out, hey, why don't we just manufacture this AI hype? And now it worked. And of course, now while the retail mom and pops are stampeding to buy from the hands of the unloaders, aka the smart money, the insiders, as you see in the massive divergence in the smart versus dumb money index. And folks, it all boils down to simple facts. We have the most reliable economic indicator in history, the yield curve inversion. Every time the yield curve has inverted to this magnitude, it was followed by a recession. It's not the only one. When we look at other credible indicators, such as commercial and industrial credit demand, it has been plummeting. And every time it went down like this, we saw a recession in the economy. But what we know is we have never seen a stock market bottom / a bull market beginning before a recession. Never happened before. Yet what usually happens before any great crash or massive economic downturn is the talk of, oh, it's all clear, everything is fine. It's a period of mass delusion when the data becomes a little confusing and can be misinterpreted one way or the other. And the pimps, of course, use the data to sell the public the fantasy that everything is okay. It happens every single time. In 2008, we know that the chairman of the Fed said no recession coming. We know that the administration at the time said no recession coming. We know that the majority of Wall Street firms said no recession coming. Matter of fact, BlackRock said we're going to see new highs in 2008 in the stock market. Even as recent as 2021, you got the propagandists at Time magazine saying why you should be wary of claims that the stock market is in a bubble, not claims that inflation is transitory. But we all know what happened to the stock market bubble. It came down crashing. Certain stocks went down by 90% and never recovered. When they say, oh, this is the Magnificent Seven. Well, they said the same thing back in 2020, Magnificent Seven, and they all went down crashing. Nothing is new here, folks. Go back to 99. Qualcomm was the hottest stock back then. If you read this headline from the LA Times, it says Qualcomm stock may need reality check. November 18, 1999, just a few months before the crash. But the pimps on Wall Street, they have no shame. That's their job. Their job is to continue to pump endlessly. JP Morgan said back then, if you compare it to many other stocks, it's not outrageous. And they raised the price target to 460 from 315, adding, I honestly don't think we're pushing the valuation envelope too far here. Fundamentally, this is a very sound story. Analysts foresee earnings of $3.79 a share for fiscal 2000 and $4.70 for the following year. Those on the upper end, such as JP Morgan, priced the stock at 73 to 90 times expected earnings for fiscal 2000. Here's what happened to Qualcomm. Insane rally that came down crashing. All of these fantasies, months later, came down crashing, and the stock did not recover for 20 years. You know what the valuation of NVIDIA right now is? Not the absurdity of Qualcomm of 73 to 90 times earnings. We're talking over 200 times earnings. You really think this is going to be different this time? Maybe you want to hear what folks said before the Great Depression. A storm unforeseen, always about to pass. The economic condition of the world seems to be on the verge of a great forward movement. June 1929. The Wall Street Journal, August 23rd, 1929. The outlook for the fall months seems brighter than any time. Wow. Irving Fisher, professor of economics at Yale University. There may be a recession in stock prices, but not anything in the nature of a crash. The chairman of the Continental Illinois Bank of Chicago, October 24th, 1929, said the crash is not going to have much effect on business. Even when the crash was happening, they were dismissing it. The New York Times, October 26, 1929, cautioning against hysterical selling. Brokerage houses in their market letters this morning will strike a note of optimism, advising the purchase of seasoned stocks at the present low levels. The public is strongly urged not to liquidate stocks in the present market. Keep your blindfolds on. Keep buying. Here's another one. New York Times, October 26, 1929. The worst is over. The selling yesterday was panicky, brought on by hysteria. General conditions are good. Our inquiries assure us that throughout the country, business is sound. The Harvard Economic Society, November 1929. A severe depression like that of 1920-21 is outside of the range of probability. We are not facing protracted liquidation. We know what followed, the Great Depression. Financial storm definitely passed, November 15, 1929. Even President Hoover, December 3rd, 1929, said, I am convinced we have re-established confidence. Wages should remain stable. A very large degree of industrial unemployment and suffering which would be otherwise have occurred have been prevented. Yeah, right. You get the point, folks. We have a major inflation problem in the economy. And if all categories in the economy were hot, then sure, the Fed should just raise rates as high as they can until these categories move back into the icy. But because we have a lot of categories already in the icy, raising rates further will cause something big to blow up. And this is going to happen, no doubt about it. Look at what's going on here with inflation. Chairman Powell says, mission accomplished, inflation is gone. We're going to be data dependent right now. But inflation in reality did not go down. Inflation only went down because of statistical manipulation. And those manipulations, the so-called base effects, are now gone. They're not going to be present in the next few readings. And folks are now anticipating a rebound, perhaps a big one, in upcoming CPIs. We see what's going on with commodities, specifically energy commodities, rebounding significantly higher. You can see the correlation between New York hybrid diesel and the US CPI year on year. We have a rebound in diesel prices, and what's going to follow is a rebound in the CPI. You look at sticky CPI, the highest since 1982. The inflation problem is still here and will get even worse. When we talk about shelter as a contribution of the CPI, perhaps the largest, home prices are now rebounding higher again, indicating a resurgence in inflation. Gas prices have hit 8 months high as oil prices soar. This is just the beginning. Bidenomics, you say. But of course, everybody will say, but Maverick, the stock market is up. That couldn't be just arbitrary. This has to be correlated to the economy somehow. It has to be a prediction that the economy will have a soft landing at some point, that the worst is behind us. Well, the stock market rally is based on 3 things, really. Number 1, China reopening. Now we know that China is in stagnation, so that's not going to work out anymore. If China actually starts to offer stimulus in the economy, that will be inflationary, and that's not going to be good for the economy. And that leaves 2 things propping up this zombie market. Number 1, the hopes that the Fed will be done with interest rate hikes, and I just showed you it's not done. 50 basis points is coming near you. As energy prices move higher, Clown Powell will be shocked, and he will have to resort to raising rates aggressively higher again. Look at the panic. We had 2 panics so far in the stock market. Number 1, when the ADP report came out way hot and the stock market flushed down, only to be fixed, quote unquote, by the government data the following day. Now, why would the market freak out because we have a hot employment report? The answer is the market says, wait a minute here. An explosion in job creation and higher wages means higher rates by the Fed. It takes the whole premise behind this rally, this fantasy. It takes it out of the picture. But that was a problem. It was fixed by the cooks at the Bureau. Mission accomplished. This week, we got another scare when rumors that the BOJ, the Bank of Japan, will start adjusting their manipulation policy of their own yield curve. In other words, it means that the Bank of Japan will start buying bonds in Japan and they will start unloading US bonds, pushing those yields and interest rates here in this country higher. In response, the stock market reversed. And then the next day, of course, rumor has it that the Treasury Department, led by Janet Yellen, called the BOJ and said, don't do it. Not right now, because I have the deluge that the department has to dump trillions and trillions of dollars because of the debt ceiling negotiations. That will cause interest rates to move significantly higher. We don't want the BOJ to add fuel to the fire. BOJ comes out on Friday, says, oh, we're just going to pledge to guide the yield curve control with greater flexibility, quote unquote. All central banks talk with both sides of the mouth with great vagueness, if we can call it that. And the reason is they don't want to panic financial markets. But in doing so, they will panic financial markets in a greater way when they can no longer hide the facts. And of course, this is going to be a big problem. If the Bank of Japan starts dumping assets worldwide, be it bonds or equities, but mostly bonds, it's not just going to hurt the US. It's going to hurt countries all over the world, from Australia, Netherlands, Brazil, France, as the Bank of Japan dumps billions, if not trillions of dollars worth of bonds, sending yields surging significantly higher. But rest assured, folks, we're going to have to face this problem again. This assumption by the stock market that mission accomplished and the Fed is done, this will be the last hike. It's not gonna be. And the reason is, you see it right in front of you right now as we speak, with oil prices moving higher again. Inflation is gonna rebound. The Fed will dismiss it at first as, oh, it's just the summer season. And then they're not gonna be able to do that anymore. And they're gonna have to raise rates significantly higher. I would argue by a sudden 50 basis points. And that's going to shock the market, and this is a huge cornerstone behind this rally that will be demolished. And that leaves the AI hype as the only hope alive for the stock market. But maybe AI is also about to be exposed. What is the use of AI among men? How about porn? Pumping 500,000 pictures a day in AI porn. That's the $70 trillion idea. Maybe we should say rest in peace AI, because AI is sexist. It's not only used to generate AI porn for men, it's also threatening 80% of women's jobs in the economy. You want a sure bet in life? Buy some put options on women. I mean, what is a woman anyway? Nobody knows. And with AI, guys are going to start banging AI. No need for dating women anymore. So for the 3 ladies who continue to watch the program on a regular basis, you better watch out. AI is coming for you. AI is the enemy. But this week, this AI premise also got exposed in a big way. To begin with, we are amidst earnings season, aka take a shot every time they say AI season. And of course, the Olympic medal, the record goes to Alphabet executives who said AI 82 times in a 60-minute earnings call. How could you say AI 82 times in 60 minutes? There should be an Olympic record for that. But it's a buzzword. It means nothing. It's meant to create mass delusion. Say the buzzword, whether you have the product or not, doesn't matter. And the delusional public will just stampede like a bunch of zombies right into the grave. But the reason why we say that AI got exposed, well, here it is. Let's talk about earnings, folks. And the most important findings from this season, number 1, we have a slowdown in growth. And this is a major problem. Look, for example, at Microsoft, the growth in Azure revenue, which is their most important product. The growth in 23 is only 26%. That's down from last year's 40%. And you're paying the same price for Microsoft stock as of last year for almost half of the growth? Doesn't make sense at all. Then we look at Alphabet revenue, 7% this year, down from 13% last year. And we're supposed to add hundreds of billions of dollars worth of valuation in a company where the growth is slowing down. We look at Meta, the growth this year is 11%. That's an improvement from last year's minus 1% when Meta had a lot of problems, but it is the slowest rate of growth since the pandemic. Now, we're supposed to stampede and chase the stock higher for a mere 11% growth. Even old school stocks that barely grow anymore, they can produce more than 11% rate of growth in revenues in a year, better than Meta. The second finding is we have an ad war, and this is a major problem. Meta cutting prices to keep volumes. So when we look at the increase in revenues, 11%, why did that happen? Cutting prices. Ad impressions up 34%. The estimate was 17.8%. The average price per ad down 16% versus the estimate down 11.2%. We also know that the company X, formerly known as Twitter, is also cutting rates on their ad prices. Next thing you know, YouTube will do the same. And we have an ad war, which will crush margins down. Finding number 3, the cost of AI. You see, we've all been sold this fantasy of AI. We've been chasing stocks higher, looking at, what AI is going to do in expanding revenues and improving margins down the line. But nobody thought about what is the cost in the immediate run of building all of these AI initiatives, because it's going to take years to see the positives. In the meantime, we will see all of the negatives. Costs will rise significantly higher, crushing margins down. And the evidence is what happened to Microsoft stock this week. After hours, the stock was moving higher, and I would argue that the report was not bad. It was actually the best among the big caps, and the stock was flattish after hours. But the moment they started talking about the cost of AI, the stock went down by 4%. So now we have a sobering moment. Wait a minute here. How much will it take to build this AI? It's no different than the metaverse. It's going to take billions and billions and billions of dollars. When are we going to reap the reward? The answer is that's years from now. So that was a sobering moment, and it creates cracks, little holes in the market's premise that, we should continue to go higher because the Fed is going to pivot and because of AI. Both of these assumptions are being challenged right now, and once defeated, goodbye ratty. The fourth finding is interest expense is rising significantly higher for corporate America. As we see rates moving higher, interest expense is also moving higher. And usually this is a recession indicator because corporate margins will collapse. Not only they have to pay more for building AI, but now they have to pay more for wages, they have to pay more for interest expense, and that could be a major problem. Speaking of labor cost, which is a major problem. Look at this illustration, for example, by Southwest Airlines. Year on year, the cost of fuel is down by 14.2%, down about $233 million. That's good until you see the increase in wages, up 25.5% or $586 million. So whatever benefit the company got from the decrease in fuel costs year on year is being offset by the increase in salaries and wages. And here's the problem. As we see energy commodities moving higher again, it's going to be a double whammy for these companies when they have to pay more for wages and they have to pay more again in fuel costs. With that background out of the way, let's do some earnings reviews here, and we've done pretty much all of these names in the members channel, and the goal is to look at all of these reports and then construct a members portfolio based on the fundamentals and see how we do. So we're going to have voting on a lot of these names, and the members will pick the names in the long and the short portfolios. So join us if you can, because by the end of this video, I would have done over 60 earnings reviews, and the goal is to do 100 earnings reviews, and that would be a record for this channel. No other YouTuber is doing this, by the way. But anyways, let's start with Chevron Exxon. Now, we know year on year, oil prices are down, so these numbers will look bad, but we have to put it all in perspective. When we look at the revenue growth year on year, Exxon down 28.3%, Chevron down 28.8%. When we look at the profit growth year on year, Exxon down 56.1%, Chevron down 48.3%. The operating margin for Exxon is 14%. Slightly better for Chevron at 16. But to put it all in perspective, we have to look at the revenue growth versus 2019. Exxon up 20%, Chevron up 25.8%. The profit growth versus 19 for Exxon is 151.7%. For Chevron, it's up 39.6%. But of course, the net income can be manipulated by charges or taxation, so I like to look at the operating margin. Now, they're both pretty much as equal as you can get, so there is no wrong pick here. But for me, as I anticipate energy prices to recover, when I look at the year-to-date performances between Exxon and Chevron, Chevron is the laggard, so I'm going to stick with Chevron here. And then we have Procter & Gamble. Look at this. We see this across company after company after company. When Clown Powell and the idiots online say that inflation is gone, what are you talking about here? The volume of sales is down across the board for Procter & Gamble, but somehow net sales are up big. 8% for beauty, 3% for grooming and healthcare, 5% for fabric, 7% for baby, feminine, and family care. All in all, sales are up 5%. So how did that happen? The answer is through jacking prices significantly higher. 8%, 9%, overall 7% for the company. So prices continue to go higher. The inflationary pressure is still here. It never went away. The consumer is paying more, despite what the CPI says. We look at the company all in all, net sales up 5% year on year. The cost of products sold down 2% year on year. So they continue to jack prices higher, regardless of the fact the cost for them went down by 2%. And they have to do that. Pay attention now, because of wages going higher. When we look at expenses, that's up 13%. And as wages go higher, companies will have to compensate for that by raising prices higher for us consumers. And this will exacerbate the inflationary pressure in the economy. When we look at the operating margin for P&G, 20.25% this year versus 18.43% last year. So the company is more profitable. You can see this in net earnings, up 11% year on year. So far, so good. The valuation of the company, that's another story, but perhaps it can be excusable by these good earnings, but they're not as good as the next name, Mondelez. Now, I happen to own this name in my portfolio. It's a long-term holding. A lot of you own the name. It's one of those names that you buy and you just go to sleep. You wake up 20 years later and you're doing fine. And unlike Procter & Gamble, when we look at regional sales, the volume was all in all up year on year, with the exception of Europe. Now, you combine this with increases in pricing across the board, it's no wonder why sales are exploding for Mondelez. Up 40.2% in Latin America, up 4.8% in Asia, Middle East, and Africa, up 11.4% in Europe, and up 22.7% in North America. All in all, sales for the company are up 16.4% year on year. Look at the net revenues, up 17%. The growth rate in the cost of sales up 11.22%. So the margins are good here because the rate of growth in revenues exceeding the rate of growth in the cost of sales and expenses, which was 11.5%. No wonder why the operating margin is improving to 16.8%, up from 12.7% last year. And the net income, the bottom line, up 28.8% year on year. Excellent report. No complaints here. I had some complaints in the last quarter, and I said to the management, you gotta increase prices higher. Across the board, jack those prices as high as you can. And they listen. Look at this. Massive increase in prices. We see increases in volumes, but the majority of the increase in revenues came from pricing. Unbelievable. We'll look at the products. Biscuits, snacks, chocolate, gum, candy, Oreos. They jacked prices significantly higher, and they're getting away with it. So when you say that the inflationary pressure in the economy is over, what the hell are you talking about? And then let's go back to the first week of earnings. We covered a lot of them. We covered all of the banks, along with some brokers such as Charles Schwab. And what I did is I looked at liquidity ratios. I looked at what will happen if deposits leave. What will happen if interest rates on liabilities increase? Sure, the interest rate on assets will increase too, and the net interest margin will be good. But what if we have an increase in the amount of liabilities to the point where they exceed the amount of earnings assets? Then we're going to see these banks blowing up. And folks, we can play with the scenarios, and it's not just the regional banks. I could show you scenarios where Bank of America blows up, and they're not really that far-fetched. Even though we have the delusional U.S. Treasury Secretary Janet Yellen, who says that she's encouraged by the quarterly earnings of large banks so far, but is waiting to see how regional lenders fare. I want you to remember this. This is the report by SVB before the collapse. Everything looked pretty good on the surface. But if you look at the details and if you play with the scenarios, that's when the problem begins. SVB, the fourth quarter of last year. The most important category you have to look at is non-interest-bearing demand deposits. Why is that important? If rates are going higher, why would you keep your money in a bank where you're not getting any interest? So those kind of deposits, the non-interest-bearing deposits, are at the most risk of fleeing all of a sudden. If these deposits go in mass, let's say 20% in a day, 10% in a day, in the case of SVB, it was 40% in a day. What is the liquidity looks like? Do they have cash enough to cover for the deposits leaving? In the case of SVB, they didn't have enough cash, number one. Number two, they had enough assets to cover, but all of these assets were held till maturity. And the ratio of available for sale securities versus held to maturity securities was relatively low. So the moment we saw over $40 billion leaving SVB, the bank collapsed. Another important finding from SVB, the ratio of non-interest bearing demand deposits to overall deposits was almost at 50%. So you have about 50% of all deposits in the bank at risk of leaving at any time. You know what the ratio is in Bank of America? It's in the 40s. So when I say it's not far-fetched, it could happen to any bank, folks. As rates go higher, the risk increases. And rates will go higher because inflation is not going to subside. And that means we have more blow-ups to come. Keep that in mind. Now, let's look at Morgan Stanley. They're supposed to be benefiting from the stock market rally, but the results say, not really. Look at revenues, quarter on quarter, down 7%, year on year, up only 2%. And the reason is abysmal performance by institutional securities, down 17% sequential, and down 8% year on year. The only segment that did pretty good is wealth management, up 2% sequential, up 16% year on year, but investment management down 1% sequential, 9% year on year. This is not good. They're supposed to be doing a lot better. On top of that, when we look at non-interest expense, up 8% for the year. So you got revenues up only 2%, but expenses up 8%. No wonder why the bottom line, the net income is down 13% for the year. And no wonder why the CEO dumped right away. The moment the stock popped higher after earnings, he dumped right away. And then we have Lockheed, and here we have a battle. It's Lockheed versus Northrop. Let's see which one does better. The sales growth for Lockheed 8% year on year, Northrop 9% year on year. The profit growth for Lockheed is up 444% year on year, Northrop down 14%. The most important segment, aeronautics, up 17.28% year on year, for Northrop up only 2% for the year. The operating margin for the aeronautics segment for Lockheed 10.24%, Northrop 10.7%, almost equal. And then when we look at the missiles segment, the growth of that segment is 0.29% for Lockheed, but an impressive 10% for Northrop. Now, Northrop is more in this segment. It's concentrated in missiles. Lockheed is more in aeronautics. We look at the operating margin for missiles. Lockheed 13.5%. By the way, operating margin means from each dollar that they generate in revenue, how much are they keeping in profit? Besides, of course, taxes and all that bullshit. So they keep 13.5% from each buck they gain in revenue from this segment. For Northrop, it's 11.7%. Now, when we look at Rotary, the growth for that segment is down 2.86 for Lockheed. It's up 5% for Northrop. When we look at operating margin for that segment, up 11.6% for Lockheed, up 15.2% for Northrop. When we look at the space segment, the growth is up 11.11% for Lockheed, but it's more in Northrop, up 17%. Now, the operating margin for the space segment for Lockheed is 9.9%, for Northrop, it's 8.1%. When we do the grading all in all, you can see that it mostly goes for Northrop, but it is subjective. It is what you're looking at. What do you see coming? Which segment that you like most? So to each his own in this one. I happen to be a fan of Lockheed. I'm going to stick with Lockheed here, and that's for two reasons. Since the bottom of 2009, you can see that Northrop way outperformed Lockheed. I think Lockheed is going to close the gap. Number two, I think the majority of the growth is going to come from aeronautics and more orders for jet fighters. And the reason is we're going to give Ukraine the F-15s, the F-16s from the Allies. And these countries will have to replenish their own stock, so they have to order from Lockheed. And therefore, I see more growth in the top line for Lockheed versus Northrop. Now, we've done the Bank of New York Mellon in our banking segment, but let's do JB Hunt. And this is really important because we got the headline that Yellow collapsed already. 99 years old company, 22,000 union members as employees, all gone. The company collapsed. And the viewer, Robert, says, "Cuz I know you have a lot on your plate, but being in the shipping business, this problem with Yellow Freight seems to me to have a hidden message. Would love to hear one of your deep dives into it someday. Thanks for all you're doing for us average working guys. You're the best." Thank you so much. Robert, we looked at Union Pacific. We looked at other trucking companies. We're looking at the transportation companies all in all, even airliners. Now, the problem with airliners is unique because we have demand going on right now. Travel demand is hot, it's going to slow down, but the headwind comes from fuel costs moving higher again. When it comes to trucking, and you have to pay attention to this segment, transportation all in all, not just trucking, but also railroads. If this sector of the economy is sick, then the entirety of the economy is sick. It is perhaps the most spot-on indicator in history for the health of the economy. It's not looking good. We look at JB Hunt, intermodal revenue. It collapsed last year, and it continues to collapse. No recovery here. So if intermodal businesses are not doing good, meaning transportation from one hub to another, from one method to another, it means that there is no economic activity in the economy. It's slowing down dramatically. It's a leading indicator that this economy is sick. When we look at the final mile services, collapsed last year, no recovery this year. So again, when we talk about consumer demand and consumer spending, they're spending more because they're paying more, but there is no new activity, net new activity in the economy. That is a major problem. We look at the top line for the company, down 18.36% year on year. Expenses down 17.86% year on year. So they're all down, but again, your revenues are down more than your expenses. The bottom line, net earnings down 25.76% year on year. Look, when a company loses 25% of its profits on a yearly basis, we got a major problem here. Either they're going to recover at some point and you believe in the soft landing, which we're not seeing any signs of here, or if this pressure continues, the company is going to be in trouble. And then let's do Goldman Sachs. And if you look at Morgan Stanley and you thought that was bad, wait till you see Goldman Sachs. It is absolute trash. It's garbage. Profits down 58%. The headline reads, you look at the pre-tax loss in the platform solutions unit, it is accelerating. We thought in Q1 it was over, but now we're down again. When you look at the trading revenue all in all, and you stack in all of these banks, it's down quarter on quarter, it's down year on year, and you can see a huge decrease in Goldman Sachs' share. Now, you look at any company, any bank, be it community or investment bank, the assumption is, at least on a yearly basis, they've issued more loans. Not in Goldman Sachs, though. Loan growth remains static, and therefore the net interest income is down year on year for Goldman Sachs. On top of that, we continue to watch from each bank what is the exposure to commercial real estate. They're all hiding their exposure. They say, oh, it's just a little tiny bit of the pie. It's all A-rated. No problems at all. The problem with this, folks, with the commercial real estate, if you believe that it is the next shoe to drop, they're not going to give us the details right now. We're going to know when we know. We're going to know when the shoe drops, because you have to look at specific companies that took loans from Goldman Sachs or Bank of America or JP Morgan, and you got to assess the health of each company, which requires a lot of details and a lot of work. If we know anything about Wall Street, they're lazy. They come on TV and they pump based on a buzzword, AI, and that's it. No homework done, nothing at all. You have to wait for the shorts to do the homework and expose all of this. But keep in mind that all of these banks, some have more than others exposure to CRE, and that's the weakest spot when we talk about the icy hot economy. When it comes to Goldman, investment banking revenue down 20% year on year, down 9% sequential. So they're not benefiting at all in the stock market rally. Net revenues down 8% year on year, down 11% sequentially. Expenses up 12% year on year. So revenues down 20%, but expenses are up by 12%. So unfortunately for a lot of Goldman employees, you're gonna get fired. They're gonna lay off thousands of employees because you look at the bottom line, net earnings down 58% year on year, down 62% quarter over quarter. Unbelievable. We're talking about Goldman Sachs here. Anyways, what about US Bank? Let's look at this one. The net interest income is up 28.5% year on year. Non-interest income, so this is really important to differentiate because net interest income, of course, it's going to look good because we have rates moving higher. But what about the core business, besides, of course, the interest rates generated by loans? So we're talking about the fees, the incentives, all of that. That's up 7% year on year. You don't want to see it down. You don't want to look at a bank's results, see non-interest income down, but net interest income is up because then it tells you that it's all about rates moving higher. But the actual business is not doing pretty good. Look at revenues all in all, up 19.3%, no problems here. But net income, the bottom line, down 10.8% year on year and down 19.7% quarter over quarter. So what is the problem here? If revenues are up, why do we see net income down? We'll look at the growth in income and earnings assets. Quarter over quarter up by 8%. And year on year up 96%. That's impressive. Then we'll look at the growth rate in expenses on interest-bearing liabilities because it works both ways. Interest rates are a double-edged sword. If you have plenty of earnings assets, you're going to appreciate in value. You're going to make more from the increase in interest rates alone. But if you have a lot of interest-bearing liabilities, those will increase too. And when we look at that, it's up 33.54% quarter over quarter, up 28.43% year on year. So the problem here is the growth rate in expenses on interest-bearing liabilities quarter on quarter, up 33.54%, exceeds the rate of growth on income on earnings asset quarter over quarter, which was only 8%. Of course, they receive a higher rate on their earning assets, and they pay less on their interest-bearing liabilities. They pay us less. So for example, on average, this quarter, they're getting about 5% on their assets. So this is what they get. The bank gets 5%. But then what they pay on interest-bearing liabilities, what they pay us, is 2.6%. That makes the net interest margin at 2.9%. This is down from 3.10% last quarter. Is it the end of the world? Of course not. But is it a problem? Sure. Because what if we see a sudden surge in interest-bearing liabilities to the point where it gets really close to the amount of their earning assets? Then profitability will get crushed. Number one. Number two, what if customers say that, look, paying us an interest rate of 2.6% when you have T-bills paying 5-6% is not really that good. If consumers demand higher rates, they will also get squeezed. The profitability will go down. And when we look at the growth rate in earnings assets quarter over quarter was 1%, but the growth rate in interest-bearing liabilities exceeded that at 4.88%. So this is a problem. Of course, the net interest margin will keep the bank alive, but you have to keep in mind, what if we see a surge in interest-bearing liabilities? Number one, what if we see demand for higher rates in interest-bearing liabilities? Then we start to talk about problems. But they don't have a problem with non-interest-bearing deposits because those are the most threat of moving away, and they're down. They keep going down. Down 5.9% year on year, down 12.3% quarter over quarter. But it is a small portion of overall deposits. So we're not going to see a problem such as SVB here. The problem that we have here is if rates go higher and consumers demand higher rates on their interest-bearing liabilities. Number two, if they continue to pile in and increase the amount of interest-bearing liabilities to exceed the amount of interest-earning assets. You got to keep that in mind. Then let's look at ASML, an important company for chips. Net sales are up 27% year on year. The cost of sales up 21.4% year on year. Research and development up 26.61% year on year. Selling, general, and administrative costs up 26.57% year on year. The operating margin was 32.7%, up from 30.44% last year. So far, so good. The bottom line is up 37.65% year on year. Everything is good here. So why is the stock down? The answer is it ran too high, too fast. So all of these good results are already priced in. Then we have to look at Las Vegas Sands. We look at casino revenue up 162% year on year. Room revenue up 205% year on year. Now you have to keep in mind that China was closed last year. So we see these big rebounds. All in all, the bottom line is up 143.25% year on year. But operating expenses up 62.2% year on year. So far, so good because the growth rate in revenues exceeding the growth rate in expenses by a lot. But we have a problem here, and you're going to see this in a lot of other companies. Interest expense. As rates go higher, all of these companies that have a lot of debt in their balance sheets, they will have to pay more in interest expense. The case of Las Vegas Sands, that was up 29.6% year on year, but it was a small amount when you pin it against the growth in revenues, so the net income was actually positive when it was negative last year. So far, so good. Then we'll look at the visitation from Macau. That's recovering too, so could be a good sign that you might want to be in these businesses, but look at all of this debt that's about to hit maturity. As we head to 24, 25, 26, it's not just Las Vegas Sand, it's many other companies, and they have to refinance at much higher rates, and that could be a problem. You look at the performances all in all for these casinos year to date, Las Vegas Sands is in the middle, the underperformer is Penn National, the outperformer is MGM, so you're not at risk here. If you're a shareholder of MGM, your stock is priced for perfection, but for Las Vegas Sand, you're in the middle of the line here. You're up 25% for the year, but what do? Either you believe the Macau recovery story, you stick with the stock, or you see yourself up 25%, you look down the road and you see a lot of debt about to mature next year, and you say, not going to be here. I'm going to bail out. That's up to you. Then we'll look at United Airlines, and we have to look at all the airlines and see which one is the best. We'll look at revenue growth for Delta, up 13% year on year. Southwest up 4.6%, United up 17.1%, American Airlines up 4.7%, and Hawaiian Airlines up 2.2%. I'll talk about why I added Hawaiian here in a minute, but the growth rate in costs year on year up 6% for Delta, up 12.1% for Southwest, up 12.7% for United, down 4.1% for American Airlines. That's interesting. Down 0.2% for Hawaiian. Look at this, fuel costs down 22% year on year for Delta, down 14.2% for Southwest, down 26% for United, down 32.3% for American Airlines, and down 27% for Hawaiian. But wages is a problem. Wages up 25% year on year for Delta, up 25.5% year on year for Southwest, up 30.8% for United, up only 12.4% for American Airlines, and up 15.6% for Hawaiian. The operating margin, 17% for Delta, 11% for Southwest, 10.7% for United, 15.4% for American Airlines, and this is why I say that if you work for American Airlines, you're probably underpaid, and then minus 1.35% for Hawaiian. The net income up 148% for Delta year on year, down 10% for Southwest, up 226.7% for United, up 181% for American Airlines, and up 74% year on year for Hawaiian, be it at a loss. If we want to score these categories individually, we can say that United Airlines is the best, but understand this, the majority of the pump is coming from international travel, which will end this season. I would say if you must buy airlines, you got to stick with the best when it comes to operating margin, which is Delta. But I would not buy any of them right now, and the reason is fuel costs will move higher and consumer demand will move down, and these companies will face a double whammy, and this was the last quarter of outperformance. The margins will not be as good as this in the next reports. Now, when it comes to Hawaiian, I talked about this as one of my potential longs, and the reason is, if you say to me, look, Maverick, we're now at the end of the year, December 31st, and all of these airline stocks are big, then I would say the one to close the gap would be Hawaiian. If I'm looking for bargains in a recovery story, I'd go with Hawaiian. But if you see these stocks down altogether, then Hawaiian will suffer the most. And unfortunately, I don't see good things for airlines in the rest of the year. So I would say no love for me, at least for me, when it comes to airlines. Then we have to look at Tesla. And again, you can read headlines that, Tesla stock is only worth $85. We got some headlines about the Roadster, which I believe it's a better idea. And it's the future of the company, not the stupid Cybertruck. But leave it to Elon to mess things up. Now, when we look at the company's earnings, revenues up 47% year on year, expenses up 21% year on year, and the bottom line, net income is up 20% year on year. What's not to like here? Here's what's not to like. The operating margin is only up 9.6% year on year, and it's in a downtrend. You can see it. It was 11.4% last quarter. It was 14.6% last year. Why is the operating margin going down? We have a price war. The company's sacrificing profitability to increase the top line, aka revenues, to increase sales. And I would say it is the best strategy for Tesla right now. If they don't do it, then you're going to see GM, Hyundai, Kia, Ford, VW, in China, BYD, and many other players eating market share away from Tesla. So Tesla has to be defensive right now. It's going to come at a cost. Profitability will be bad. And the next quarter, the operating margin will probably be down, even more than 9.6%. Now, you looked at many other earnings. Some of them are old school companies with stagnant growth, but they have better operating margin than Tesla. So when you look at the valuation of the stock versus the operating margin, the story doesn't add up. The stock becomes extremely overvalued, and hence the lukewarm reaction by the stock. It went down by 10%, and it's going to go down more because the company is less profitable than it used to be. It's going to become less and less profitable as this price war continues to go on. Then we have to look at Netflix, see what's going on here. Revenues up 2.72% year on year. Cost of revenues down 0.36% year on year. Expenses all in all up by 2.62% year on year. The operating margin a minimal improvement at 22.31% versus 21% last year. The bottom line net income is up 3.23% year on year. Now look at what the stock did year to date. These numbers don't justify the move, and therefore we saw NFLX down by more than 10% when the report came out. And the problem here is, sure, they're adding more members, but they're not getting more revenue per member. Those numbers are going down. Look at USA and Canada, down quarter on quarter, an improvement year on year, but it's only 5 cents. Look at EMEA, the average revenue per membership, down quarter on quarter, and down year on year. Latin America, the average revenue per membership, down quarter over quarter, and down year on year. Asia Pacific, same story, down year on year, down quarter over quarter. So the profitability is a problem here. And therefore, you look at the company's valuation where the stock is trading right now and you say, okay, these results are not really impressive. Maybe I made a lot of money on Netflix this year, but now the results don't support the price. So I better get my money out and rotate to another growth story. And that could be energy, for example, this summer. And therefore, you see these stocks, money coming out and moving elsewhere. The dummies, of course, they buy the dip. That's all what they do. That's all what they're programmed to do. Yet, with these results, I'm not impressed with Netflix here. I think you have to be stupid to buy the stock at this point. And then what about Dinosaur, IBM? Revenues down 0.38% year on year. Expenses up 1% year on year. The operating margin is an improvement, 13% this year versus 11% last year. The bottom line, net income is up 13.72% year on year. What do you do with the stock? It is cheap, it's value, pays dividend, but it's not a sexy story. It catches a bid after earnings. They can say AI all they want. There is no love for IBM out there. It's a stagnant company, and there's nothing exciting here. So we're just going to pass on this one. How about TSMC, an important company for chips? Here's the headline. Taiwan Semi second quarter net profit fell 23% on lower revenues and margins. Look at this. Quarterly net income collapsing. So when you see all of these chip companies, the stocks, of course, not the actual companies, but the stocks, shooting up higher based on this AI hype, but the results in real life, they don't reflect any of that at all. Look at net revenues, quarter on quarter, not just year on year, quarter on quarter, down 5.5%, and year on year, down 10%. Expenses up 5.2% quarter on quarter, and up 9% year on year. This is a bad setup. You have revenues going down, expenses going higher. No wonder why the bottom line, the net income is down 12.2% quarter on quarter, and down 23.4% year on year. So again, Taiwan Semi is the manufacturer of NVIDIA's chips. How come it's not reaping any benefit from the massive increase in the revenue guidance by NVIDIA? Something doesn't add up here. What I believe is NVIDIA got some orders, some promises, but they're not going to really materialize. Then we have Freeport, a company that I own, lots of you own. It should be in any portfolio, really. If you believe that the future is EVs and all of that, you got to invest in copper. And this is a good vehicle. The problem here is that prices of copper are down year on year. So all in all, you can see that the average realized price per pound, that's down year on year. If we look at regional, North America, that's also down year on year. South America, that's down year on year. Indonesia, also down year on year. With that being said, revenues all in all up 6% year on year. But here's the bad, expenses are up by 17.58% year on year. No wonder why the operating margin took a hit, 24% this year, down from 32% last year. And of course, the bottom line, the net income unfortunately is down 29.57% year on year. But why is the stock doing pretty good still with these results? The answer is you look at the prices of copper. Here's a weekly chart for copper futures. We have what it appears to be a pattern of lower highs and higher lows, what is known as a triangular pattern. Now, as the dollar goes down because Clown Powell says mission accomplished, we expect the prices of copper to move higher. The headwind has been China reopening. It was a hype. It never really lived to the hype, and therefore we see copper prices down. But if we have the dollar going down and maybe a stimulus package coming out of China in October, for example, then we should see copper prices recovering, and any slight improvement in the average realized price by Freeport-McMoRan, FCX, will improve these margins dramatically, and the stock will go higher. If copper prices go down, then we got a problem. Look at Johnson & Johnson. The headline reads, a surge in heart procedures helped drive Johnson & Johnson revenue. What are they talking about? We look at regional sales, up 10.2% in the US, up 2.2% internationally. All in all, up 6.3% year on year. We'll look at different segments: consumer health, pharmaceuticals, medtech, all up for the year, and all in all, sales for all segments up 6.3% year on year. Revenues, as we said, 6.3% year on year, but the cost is up 3.7% year on year, so the margins should be good. The problem is, here we go with wages again, selling, marketing, and administrative costs up 7.1% year on year. R&D up 3.4%. That's not a problem. The problem is wages. So they have to raise prices higher again. With that being said, net earnings, the bottom line, was actually positive by about 7% year on year. I wonder why the stock reacted positively. I have it. Lots of you have it. It's a good stock to hold. With these results, with recent restructuring, I would say keep it in the portfolio for now. Then we have to look at Ally Capital. Maybe we have a problem in this one. We'll look at the growth rate in assets, up 6.2% year on year, but not all categories are created equal. For example, interest-bearing accounts, that's up big year on year. But investment securities, that's down about 10% year on year. We'll look at finance receivable, which is the core business of this company, up a little bit year on year, up quarter on quarter, no problem here. The problem becomes the fact that liabilities grow at a faster rate at 7%. Interest-bearing liabilities grew at 10% year on year. So now we have to talk about the same problem. What happens if you have your interest-bearing liabilities increasing at a faster rate than your earning assets? Then you're going to have margin pressure, and the company is already facing that. We'll look at total financing revenue and other interest income, up 41% year on year. So far, so good. Here's the problem. Interest expense is up 260% year on year because they have a lot of liabilities. So we see net financing revenue down 11% year on year, and the bottom line, the net income, is down 32% year on year. These are the kind of problems, folks, that you have to look into. As rates move higher, you have to play with the scenarios, and the accountants in these companies have to play with the scenarios. They have to identify the risk before they face it. And of course, when we talk about Ally, it's all about auto loans. When we talk about subprime auto loans, that could be the next bomb, etc., etc. Now, when we look at auto loans and we look at no FICO, subprime, and non-prime, it's not a huge component of overall originations, but my fear is that a lot of these folks in the prime/near and even the prime category, they're not going to be so prime when they lose their jobs, and they're paying $1,000 plus in monthly payments in auto loans, and that could hurt the company dramatically. So on face value, we could say, hey, this is unlike 2008. We're not going to see the same subprime mortgage problem, but can you guarantee that anybody with a prime rating after losing their job is going to be prime again? That's something we have to think about. Then when we look at Capital One, get tied in with Ally Capital, same concerns, but it could also be a potential for an opportunity. If you believe in a soft landing, you can bargain hunt here, but that comes with a lot of risk. When we look at the LCR, the liquidity coverage ratio, it went higher, be a tiny bit, not a big major move. And the reason is liquidity reserves are down 7% quarter on quarter. So the company has less cash. Is it a major concern right now? Absolutely not. But is it something we have to keep in mind? Yes, we have to add it to more evidence. So let's continue to dig here. When we look at the credit card segment, the net interest income is up 21% year on year. Non-interest income, which means the fees, are up 6% year on year. All in all, the net revenue for credit cards up 17% year on year, but non-interest expense up 9% year on year. So far, so good. This is not what we're concerned about. What we're concerned about is net charge-offs. Quarter on quarter, that increased by about 35 basis points. Year on year, that's up big, almost a double. So we have a lot of bad loans here increasing. It's not a problem yet. But if you go back to 2008, there are a lot of banks that blew up because they have net charge-off rate that increased to 5-6%. And that was enough to blow up the company. So that's something you got to keep in mind. The other thing is when we look at the purchase volume for credit cards, quarter on quarter up 11%, year on year up 6%. Now, what does that mean? Consumers are using credit cards more. That could be because inflation. That could be because they're running out of savings. It depends on how you look at it. The bulls would look at this as, look, more retail spending. The bears would look at this as, hey, they're using credit cards. That means they have to use these credit cards to cope with inflation. So we have to look at domestic cards. The net interest income is up 22% year on year. Non-interest income up 7% year on year. All in all, the net revenue up 18% year on year. The non-interest expense up only 8%. So far, so good. Here's the problem. Net charge-offs also up quarter on quarter. We'll look at the 30 days plus delinquency rate also increased quarter on quarter. So we have problems here. We have folks who are using their cards, but they're having trouble paying it off. It's not a major problem yet, something to keep in mind. The purchase volume is up 11% quarter on quarter, up 7% year on year. So we have more and more spending. When we look at the consumer banking segment for Capital One, net interest income up 6% year on year, non-interest income up 55% year on year. All in all, net revenues up 8% year on year. So far, so good. We look at auto loan origination. That's really important. Up 15% for the quarter, but down 31% year on year. What does that mean? We can look at it as used cars inflation, for example. Folks say, oh, used cars prices are going down. That's the good. It means the CPI will go down. If you look at these results, down 31% year on year, maybe we've accounted for the majority of disinflation in used cars prices because quarter on quarter, that's up 15%. So when we talk about rebounding inflation, if you look at these results, you could say, and you can make an argument, that we will see a rebound in used cars prices coming. Now, the good news here is net charge-offs are actually down quarter on quarter. So that's the good news. When we look at commercial banking, net revenues down 2% year on year. It's the smallest segment for Capital One, so it's not a huge deal here, but the average deposit interest rate is 2.68%, so that's not enough. The net charge-off rate is exploding higher here at 1.62%. The number itself is not concerning, but the growth rate is. So keep that in mind. Now, every bank will let us know about their exposure to commercial real estate and say, hey, it's not a big deal. We're going to deal with it this way or that way. It's not a huge exposure. Capital One is doing the same. And the way they're dealing with it is they're transferring some of that exposure to commercial real estate to become from LHFI, liabilities held for investment, to liabilities held for sale. So you have companies like BlackRock, for example, buying all of this exposure. And this is the way that Capital One is dealing with this in reducing their exposure to commercial office real estate. Is it going to work? Is it not going to work? Who knows? Because the devil is always in the details, and we need a lot of research, a lot of time to actually dig down and see what the exposure looks like, which companies, what other risks are. Of course, the short sellers will do the job and they will bet accordingly. Look at the company all in all. Capital One net revenues up 9% year on year. Non-interest expense is up 5% year on year, but the net income is down 30% year on year. So we have a problem here because there was a lot of charge-offs. The increase of rate year on year was big. And when we look at the details of net charge-offs, you look at retail banking, that's up quarter on quarter. But the biggest increase was from commercial and multifamily real estate, so we can see that this is a problem. It is brewing in the economy, and net charge-offs were up big quarter on quarter. Autos up quarter on quarter, but it's not a major increase. Retail banking also up quarter on quarter, big increase relatively, but not as an overall amount. And again, folks, when you assess the risk in these banks, you have to play with the scenarios. You have to tweak these scenarios. What happens if rates go up to this? What happens if deposits decrease by this amount? What happens if liabilities increase by this amount? What happens if the net charge-offs in a certain segment increase by more than 50% in a quarter, more than 100% in a quarter? So on and so forth. And then we have to look at CSX. We looked at Union Pacific. Let's see if this is any better. Revenues are down 3% year on year. Expenses are up 5% year on year. The operating margin is 40%, but it's down from the 44% operating margin of last year. All in all, the net earnings are down by 15% year on year. So we go back to the icy hot economy, and we talked about trucking, we talked about transportation as being icy. And you see that reflected in these earnings. We did American Airlines. Let's talk about D.R. Horton among the hot category in the economy, but perhaps it is peaking. Why do we say that? Revenues up 10.66% year on year. The cost of sales up 21.5% year on year. Expenses up 15% year on year. And here it is, the bottom line, net income down by 18% year on year. Look at the balance sheet. It's all about, the inventory is coming. But the highest margin inventory for D.R. Horton is single family homes. You look at construction in progress and finished homes versus September of last year, it's down 4.55%. So you put it all together. It was a romantic story this year that we have more homes coming, we have a shortage of homes coming, and D.R. Horton will deliver. And therefore, we have to stampede and buy the stock. But we can see from the results of the company, their profitability is down, and the upcoming inventory is actually down. So you look at the weekly chart for DHI, way out of whack, showing perhaps a reversal candle. I would say that this is as good as it's going to get right now this year. Let's do Blackstone. Here it is. And again, massive improvement if you look quarter on quarter, if we look at year on year for this quarter. But you have to understand that last quarter was a disaster for Blackstone. And therefore, when we look at the growth in revenues or even the net income, the first half of the year, this year versus last year, it's all negative growth. But the concern when it comes to Blackstone is outflows. We'll look at the net flows, they're positive for the year. We see more inflows than outflows in most categories, with exception of hedge fund solutions. But understand this, Blackstone has been prohibiting outflows out of real estate funds. We have to play with the scenarios. How long can they maintain this charade of preventing any outflows from real estate funds? And if we see outflows increasing out of real estate funds from Blackstone, the question now becomes, do they have enough liquidity to cover? And I'm talking about cash, because that's what's going to matter right away. When we look at cash, they only have about $3.2 billion. And cash and net investments all in all are down year on year. Now, Blackstone can sell assets to compensate for that, but this is when the problem begins. So again, folks, when we look at this economy and all of these companies, it's all about interest rates. What if they go higher for longer? What happens to deposits in banks? What happens to outflows from real estate funds and Blackstone? All of these are good questions that must be asked. Then let's look at Amex, American Express. Let's see what's going on here. Non-interest revenues up 8% for the year. Interest income up 71% year on year. So we know that the majority of growth here is coming from higher rates. We'll look at interest expense because it is a double-edged sword, up 280% year on year. But again, the core business is doing okay, and expenses are only higher by 7% year on year. So the bottom line, the net income is up 11% year on year. So far, so good. And the majority of spending in Amex cards is coming from millennials and Gen Zers, up about 21% year on year. Gen X up 8% year on year. Boomers up 3% year on year. All in all, it's up 10% year on year so far. So good. Here's the problem. Folks are using the cards, but are they able to pay it back? Specifically now that we have student loans that have to be paid back in September, October. Therefore, we start to see the write-offs increasing in Amex. Of course, the company would use some accounting tricks and say, oh, look at the net write-off rates. Yeah, that's increasing, but it's below the pre-pandemic rate. I don't buy it. I look at the pure write-offs and they're going higher. And perhaps this is why the stock went down. We'll look at net card fees growth. It has decelerated, peaked already, and now it's going down. And that's a problem for the company. That perhaps the stock went too high too far and it needs to cool off because growth in the company all in all is cooling off. Then we look at SLB, a company that I own, a lot of you own, and if you believe that energy prices are about to rebound, it is absolutely the best name to own. The reason is you look at Chevron, Exxon, oil prices are down. We see revenues, net income down big for the year. But this is an oil service company, and they have a lot of pricing power. Even with oil prices down, look at revenues internationally up 21% year on year. In North America, up 14% year on year. They're also up sequentially. Impressive. We'll look at the different segments of the company. Again, the growth sequentially is up across the board, 5%. Year on year, 20%. Up double digits across all segments, the exception being digital and integration, down about 1% year on year. No biggie here. Likewise, we'll look at the operating margin, up across the board for the year, with exception of digital and integration. That's down a bit, but for all other categories, it improved. You put it all together, revenues are up 19.5% year on year. The cost of revenue is up 16.77% year on year. And the bottom line, the net income is up 11.5% year on year. What's not to like here? And lastly, let's do Comerica. Again, we talked about the risk in these regional banks. So we look at net interest income for Comerica. Quarter on quarter is what's really important because we're watching for stress in these regional banks. Quarter on quarter, net interest income is down 12.28%. Not good. The net income, the bottom line, is down 16% year on year, and deposits are also down year on year and down quarter on quarter. So we got a problem here. What is the problem coming from? The net interest margin is down quarter on quarter. It used to be 3.57. Now it's up to 2.93. Why is that happening? We see earnings assets moving higher. Now we have to look at the liabilities in a minute, but we'll look at non-interest bearing deposits. Down 15.7% quarter on quarter. That's big. So they're losing a huge amount of deposits because these guys and gals are not getting paid for keeping their money in Comerica. And non-interest bearing deposits are almost half of overall deposits in this bank. We've seen the same thing happening in SVB. Not saying the bank is going to collapse, but I'm saying that this is a huge problem because all of these deposits are losing to inflation and they're better off being parked in T-bills or money market funds. But for now, is it a problem for the bank? It's a problem if we have mass exodus all of a sudden. But what I see perhaps as a more immediate problem is, what if these companies decide, look, we know the problem with having accounts that are not receiving any rate. They're at the risk of leaving any time. What if we decide to pay them? What if we decide to pay more on interest-bearing accounts? Then you have to look at earnings assets. What are they getting? They're getting about 5% interest rate. So far, so good. We'll look at the interest rate for interest-bearing sources, the liabilities, 3.5%. So there is a gap in interest rate. They receive more than they give. That's the nature of the business. But what if liabilities explode higher? Because accounts that are non-interest bearing and now moving to become interest bearing. Number one. Number two, what if they demand higher rate? All of these questions that we have to ask right now, and most importantly, the Fed, the regulators, the accountants in these banks, the managers, they have to play with the scenarios and identify where the risk is and plug these holes ASAP. And here we have a question from the viewer. It says, hey Maverick, what are your thoughts on entering a long position in McDonald's versus KO, which is Coca-Cola? We can do the comparison if you want, but I can tell you right away, McDonald's was perhaps, in my opinion, the best earnings report that we got this season, at least so far. But for now, in the short run, if you look at the charts of MCD versus KO, MCD ran way too high, too fast. It needs to cool off. On the other hand, Coca-Cola hasn't done a lot this year. So in the short run, I'd go with Coca-Cola, but if McDonald's goes down by, let's say, 5, 6, maybe 10% preferably, then we should consider adding it to the portfolio because the company is doing a remarkable job in increasing revenues, reducing costs, and their margins are up almost 100% year on year. Now folks, before moving on, we've done some pre-earnings plays and we usually like to play both sides, having exposure to the upside and the downside, and paying as little as possible. We had some good trades this week on Meta, on Alphabet, on Microsoft, so we're going to follow up on that on the members video because if I do that, this video will be 2 hours long. I don't want to do that. So with that folks, let's move on and cover the market information for you. We begin with the closing of the indices on Friday and here we go. On Friday, the Dow Industrial Average was up by 176.57 points, or a gain of about half a percentage point. The Nasdaq up by 266.55 points, or a gain of 1.90%. The S&P was up by 44.82 points, or a gain of 0.99%. We look at these sectors all in all on Friday, all in the green with the exception of utilities. We also have real estate being flattish, but the top gainers, communication services, consumer cyclicals, and technology. Thank you to Google and Meta. We contrast this with the weekly performance. What do we see here? Once again, thank you Alphabet and Meta because at number one, capturing the gold, the silver, and the bronze, communication services. On the other hand, the laggards led by utilities, real estate, and healthcare, no love for defensives this week. We'll look at the breadth. NYSE 71% advancing versus 28% declining. The Nasdaq 72% advancing versus 25% declining. So we have to go back to the neutral line at around 50-50. And that could happen as soon as Monday as we see more defensive/neutral tone as we anticipate reports from companies such as Amazon and Apple. On to commodities, and as we see the dollar being flattish on Friday, the majority of the gains coming from energy commodities across the board, whether we're talking about crude or natural gas, heating oil, were all up on Friday. The exception being gasoline RBOB, which was flattish. And of course, when we talk about crude oil, we have more data that demand is actually increasing. So we talked about the cover that we have from the supply side by Saudi Arabia and the OPEC Plus and the reduction in seaborne exports by Russia. And the problem all along has been demand from China being weak. But we also have demand catalysts coming out. We see the global demand actually moving higher. And on top of that, we have the prospects of refilling the SPR. We'll look at other commodities. Mixed picture across the board. Notable losses and pullbacks in grains. Notable gains in copper futures, up about 1.5% on Friday. Now, when we look at the monthly performances across the board for these futures, they're led by commodities. For example, orange juice commodities are up by 24.5% almost for the month. You got the gasoline RBOB up by a little over 18.5%. The WTI up by over 16%. Brent up by more than 15%. It goes on. So we're seeing reinflation happening right now. And this will be reflected in the CPI. Perhaps not the most immediate one, but these increases in prices will show up. And with that base effects, you have to assume that the CPI will go higher. Moving on to options, the big casino, what do we see here? All in all, the volume is quite shy on Friday, and we see more buying of puts versus calls. Is it a one-way wonder? We'll see. Yet what we know is, for months now, there was no love for puts at all. It's been all buying of calls. Now we see a little demand for puts. Perhaps the scare by the BOJ made a lot of folks rethink and buy some puts. We also have the seasonality of the VIX coming out, which indicates that the VIX should move higher in the month of August. Another piece of evidence that we will see more demand for puts. And the message here, folks, I want you to look at the IV rank for these names. In the case of Tesla, for example, it's at 0, which means that this is the lowest implied volatility in about a year. In other words, sure, the implied volatility might be at 40 or 50% for Tesla, but the options are the cheapest they've been in about a year. Now we look at Palantir Technology. The IV rank is at 100%, so these options are the most expensive they've been in about a year. And the implied volatility for Palantir also happens to be 100%. In other words, this is the time for you to capture the elevated implied volatility by doing what? By riding calls and riding puts. If you're going to buy calls right now and you're going to buy puts, it's a fool's errand. I'll show you why. Here's Palantir. Let's say you're going to buy the $20 calls for the expiration date of August 18th. Now, who knows what the stock is going to do, but the point of this exercise is look at the implied volatility. It's at 100 right now. What if we reduce the implied volatility to, let's say, 75%, which is possible. It's inevitable now that the IV rank is at 100. Look at what happened to these calls. They lose value even though the stock remains at the same price, just by the reduction in implied volatility alone. What if you're buying puts in Palantir? Let's say you're buying the 16 puts, you think the stock is going to go down after reporting. The implied volatility is 94%. If the stock does nothing at all, and the implied volatility goes down from 94 to, let's say, 76, your puts will lose value based on that alone. What is the point here, Maverick? The point is, you gotta hunt for lower implied volatility because you can buy those, and if you believe in the seasonality of the VIX, that we will see volatility increasing, your options will gain value based on that alone. Example, look at the SPY. The implied volatility is about 12%. It's really cheap. You buy the 450 puts with the expiration date of August, for example. Let's say the implied volatility moves from 12% to, let's say, 15%. Not a major move. But look at this. All of a sudden, your put options are increasing in value based on that alone, based on the VIX moving slightly higher. So keep that in mind. The headline reads, "It hasn't been this cheap since 2008 to protect against the stock market sell-off," or stock market sell-off, pardon me. And this is according to BofA. What are they talking about? Here it is. The cost of hedging is really, really cheap. Everybody's going naked. Everybody assumes that this is a bull market and there's nothing to worry about at all. This is the time to start accumulating these puts. They're cheap and you're going to get rewarded by the increase in volatility alone. Let's do some unusual activities that took place in the options market on Friday and then move on. And we start with the FXI, the Chinese ETF. If the dollar goes down, Chinese equities should do good. And of course, we have talk about perhaps the Chinese government issuing more stimulus, and that could add up too. So somebody bought the 32.5 calls for the expiration date September 1st, with the expectations that the FXI will gain more than 8% by the expiration date. They paid about 50 cents a piece to enter this trade, all in all spending about $2.5 million. And then we have UPS. We have the tentative deal with the Teamsters. Wage costs will go higher, but somebody sees this as a positive catalyst for UPS, and they bought the 200 calls for the expiration date September 15th, with expectations that the name will move higher and gain more than 6.5% by then. Paid about $2 a piece to enter this trade, all in all spending about $3 million. And it goes hand in hand with the FXI, the ticker BABA Alibaba. Somebody sees the name moving higher and they bought the 115 calls for the expiration date September 1st, with expectations that the name will move higher and gain more than 14% by then. Paid about $2 a piece to enter this trade, all in all spending about $2.5 million. Last but not least, what about the ticker MET for MetLife? This is quite unusual because the name doesn't move a lot, but somebody's bidding for a sizable move here. They bought the 67.5 calls for the expiration date October 20, with expectations that the name will move higher and gain more than 8% by then. Paid about $1 a piece to enter this trade, all in all spending about $1 million. On to the heat map from Friday. What do we see here? More inflows into big cap technology stocks. A lot of this is short covering when we look at names such as Meta, Tesla, Amazon, even Microsoft. The assumption is that earnings did not collapse. They were better than feared. Are the prices too high for the deceleration in growth? Absolutely. But the assumption heading in by a lot of folks was we might see negative growth in some of these names. So they shorted ahead of time, but that did not materialize. And what we see is a lot of short covering on Friday. Now, that doesn't mean that these gains are going to stick next week. What you're going to see actually a lot of managers, for example, looking at Microsoft, and it's the same price that it was in 21, yet the growth in Azure is less than half than it was in 21. So is it worth it really? They're going to start to book profits and rotate into other sectors that are showing growth and perhaps possibility of more growth as we see an episode of reinflation this summer. And that could be in energy or metals or industrials or even consumer staples. I mean, we've seen what happened with Mondelez, raising prices, yet the consumer remains receptive, and they're getting away with it. Of course, we have negative reactions in some of the earnings that we got this week, such as GM, Ford, and that stuck all the way till Friday. When we contrast this with the weekly heat map, what do we see here? It's all about earnings. And when it comes to earnings, it's all about expectations. If companies beat expectations, even though if the report's not really that good, we see names moving higher. Examples, Boeing, UNP, Meta, Alphabet, Freeport, for example, in copper. The net income was down. Stocks moved higher either way. A lot of names in energy. Year on year, revenues, net incomes were down, but better than feared, so these stocks moved higher. Then you have companies that did not deliver to meet expectations. Some of these companies in healthcare, for example, we see Bristol Myers down, we see Merck down, even though Merck is going to report this week. In industrials, you have RTX, Raytheon was down big. You have Waste Management down, you have Honeywell down, you have the airliners down, and of course we have Ford, GM, Chipotle, CMG. It's all about expectations, folks. If we're pricing in a romanticized story and the stock doesn't do pretty good, it crashes. If the expectations are that the stock is going to crash because earnings will be bad, and then they come out and they're not really that bad, defying expectations, we see stocks moving higher. We move on to the weekly heat map for the ETFs. What do we see here? The notable finding is this week was all about large cap growth stocks, even though value closed positive, even though small caps closed positive. It was all about Google and Meta, and also the chips. You see the SMH, the SOXX all up for the week. Regional banks, better than feared. We see KRE up about 5%. Also energy, XOP, XLE, OIH, all up for the week. And of course, Chinese equities. Look at the gains in the FXI, MCHI, even in the EEM, emerging markets, all up big for the week. Now, all of this is dependent on what the dollar is going to do this week. If the dollar continues to rebound, the map will change altogether. It's all about rates, of course. If rates continue to move higher, you're going to see a lot of these gains in the KRE, for example, reversing down. So let's do some charts and then wrap it up. We begin with SPY, the S&P 500. This is a 30-minute chart. What do we see here? We got the Bank of Japan scare on Thursday, and the BOJ came out and said, well, we're not going to do anything right now, but we're going to be flexible. So we get the relief pop on Friday, but it did not change anything at all. Support remains 454, resistance at 459. We closed within range. Nothing to see here. Look at the daily chart for the E-mini futures. What do we see here? And again, you can look at the SPX. We'll do that in a minute, and you can say, oh, this is a bearish engulfing candle, and down we go. All of that is good talk. But when we look at the continuous contract here, did we lose any support line? Most importantly, 45, 49.5, the answer is not at all. We know what's going on with the momentum, the RSI and the MACD. We know it's too hot, it's too extended, it needs to go down. But we need to see some support lines being broken. Otherwise, the market wants to go higher. Once it starts to break these support lines, then we're talking. And here's the SPX, the cash index daily chart. We use the Bollinger Bands. We know when you have a divergence outside of the upper Bollinger Bands, combined with an elevated RSI, the odds say we have to pull back. And this week, we got a little bit of a pullback on Thursday, not quite all the way down to the 20 MA. And folks, we'll look at this as a reversal candle, an engulfing candle. I would take it one step at a time. I need to see loss of support lines on the daily chart of the E-mini futures and the hourly or 30 minutes chart of the SPY. If we start to see that, then we're going to lose momentum. And if we go down to the 20 MA and that test has failed, then we talk about a reversal in trend. Look at the Qs, 30 minutes chart. What do we see here? Again, we got the BOJ scare, got us all the way down from 385 almost to 376, which has been support for a while now. Then came the statement by the BOJ and got us where? Got us back within range. Support 380, resistance 385. Nothing changed for the week. Now, we can look at this as a triangular consolidation pattern with a lower high and a higher low, and it could break either way, but the point being is it could break either way. So we have to look at the daily chart for the continuous contract for the Qs. What do we see here? We keep the bear flag pattern, but understand this. If the chart closes above 15,975, it wants to go higher. You need to see a break in one of these support lines. Most importantly, 15,500 before we see a legitimate pullback. Now the question is, are we getting closer to a significant pullback? The answer is absolutely. If we look at the daily chart for the NDX, the big NASDAQ, we use the Bollinger Bands, we got a pullback, folks. And the pullback got us all the way down almost to the 20 MA. Now we have negative divergence on the RSI, and we're waiting to see if we have another retest of the 20 MA. If that fails, then we have a reversal in trend. But we got that before, folks. We got one in March, then came the Fed and rescued the chart. We got one in April, which was proven to be a bear trap, But the difference between now and then is, back then, the RSI was in positive divergence. Right now, it is in negative divergence. So we need to see the break, we need to see the confirmation, and then we have a reversal in trend. And of course, we have a lot of chartists who look at the McClellan index, for example, and they see that the trend is already reversing. That could be a leading indicator, but I'd like to see a confirmation. Here's the IWM, the Russell 2000 small caps 30 minutes chart. What do we see here? We got the BOJ scare, got us all the way down from above 197 all the way below 195. And then on Friday, we got back in range. 195 support, 197 resistance. What are we waiting for here? We have to look at the weekly chart for the IWM. What do we see here? Divergence outside of the upper Bollinger Bands. We need to pull back. We said that last week. And you can continue to diverge all you want, but the higher it goes, the bigger the pullback. I would say the risk versus reward says we're going to pull back in the IWM. Dixie, what do we see here in the daily chart? It closed pretty much at the target that I identified, which is the top of a breakdown candle, but it did close above the 20 MA. Is that bullish or bearish? The answer is it is bullish for now, but we need to see more by the dollar. We need to see it capturing 103 as support. And if that is the case, if this is not just an inverse ABC pattern or a dead cat bounce, then the expectations are we will see more pain in equities market. Perhaps this time around it's going to stick. And most importantly, we will see more pain in gold because we got some pain on Thursday, a little bit of a rebound on Friday, but this is why I'm saying, folks, I'm not in a rush in chasing gold. The momentum is now cooling off, flattening out. It might reverse from being bullish to bearish. Maybe we'll get a retest at 1928. For now, gold is holding on to the 20 MA. If it loses that, we're going to have a problem. Most importantly, the dollar continues to move higher. We might see gold even breaking 1928 as support. The same goes for the SLV silver. It is right now at the 20 MA, but look at the MACD indicator. We have a confirmation that we're losing momentum here. If the dollar continues to move higher, SLV will go down more. And therefore, I'm not in a rush, folks. The time will come for buying gold and silver, but we have to have a resolution in the Dixie first. And instead of chasing gold and silver, look at what's working right now, despite the dollar moving higher. This is the weekly chart for crude oil. What do we see here? Number one, we have positive divergence in the RSI. We have positive momentum now accelerating in the MACD indicator. We have closings above the 20 weeks moving average, and the chart is about to expand the Bollinger Bands higher. So this is a bullish setup, not a bearish one. Could it change? Sure. But for now, you got to go with what's working, what's showing relative strength. Even though the dollar goes higher, we see crude continuing to go higher. We'll look at the daily chart for the 2-year yield. What do we see here? Nothing to see, closing above 4.87. Is that bullish? The answer is yes, but is the formation bullish? Well, you can argue that this is a bear flag, and down we go. You could also argue that we have a pattern of higher highs and higher lows, and we will make a higher high. For now, the assumption has to be higher for longer. If that is the case, we'll look at the TLT weekly chart. What do we see here? The momentum is weakening. It is now below the 20 weeks moving average for weeks now, but we see the RSI and the MACD moving down. We see the volume moving higher on down days. So the assumption for now has to be that we should see a retest of the lows at around 91.85. VIX daily chart, what do we see here? Holding on to the lows. I'm going to keep the bear flag, but if we look at the weekly chart, what do we see here? Look at the MACD. The momentum is bottoming when we talk about bearish momentum, or we're about to see bullish momentum in the VIX. This is what the seasonality suggests. If you look at this chart, for example, July is the bottom for the VIX, and August usually is a good month for the VIX. So you have to think about what we talked about in the options analysis. Puts are really cheap right now. Take advantage, folks. Hedge your portfolios. If you want to make downside bets, do them now. Apple, an hourly chart. What do we see here? We have a major trend that has been broken, and the chart failed to recapture this major trend. We got the AI pump. It was a pump and dump. Now we have a minor trend. These are the leading indicators of a weakening chart. Now, does that mean that Apple is going to crash? No. But it means that we could see perhaps an inverse ABC pattern, and the momentum starts to change in Apple. Of course, this week is going to be a fundamental week for Apple because we have earnings coming out, so we have to stick around for that. Tesla, daily chart. What do we see here? Using the Bollinger Bands, the question becomes, do we have a closing below the 20 MA? The answer is yes, we do. That's check mark number one. Do we have a bear flag formation pattern? The answer is yes, we have check mark number 2. Can we argue that this could be a formation of a head and shoulder? The answer is yes. That's another check mark. But do we have a bullish argument? The answer is yes. If we zoom in to an hourly chart, what do we see here? Holding on to the lows, let's say at around 255, 256. And now maybe forming a bull flag pattern. It closed above 265.25 on the hourly chart. Can Tesla rally a little higher? Maybe all the way to 276.47 and then form the shoulder on the daily chart? That is a possibility. You gotta track the hourly chart. If it fails in or around 276.47 or even before, better yet before for the bears, then you'll know that it doesn't have the energy to climb higher again. Then let's look at some weekly chart for these big technology names. We'll look at Amazon. What do we see here? It is stalling right now. The momentum is cooling off. It's all about earnings this week. But what we know is this chart remains in a bear market. And perhaps it is a leading indicator that what we're seeing right now is an AI hype. It's not a real bull market. Otherwise, Amazon should be back at the highs. And maybe it will after earnings. But what we know for now, the stock down top to bottom, 56.71%. And then we have a rebound of a little over 66%. It's a Fibonacci retracement line, if we use that. Now what happens? If the report's not good, chart goes down, we have a leading indicator that the bear market will resume. We'll look at Google, perhaps the cheapest among the big caps. And I said before, if you hold the gun to my head and say buy one big cap stock, I would go with Alphabet. GOOGL, and the reason is it's not at the highs yet, and it's the cheapest when it comes to valuation. But the stock right now, looking at the weekly chart, got to my target at around 133.29. And I think you're going to have a hard time continuing this rally. And the reason is managers will look around and say, okay, we're almost at the highs. The growth of the company is actually decelerating. It's not as impressive as it used to be before. We have an ad war, which will reduce margin, not to mention, of course, the cost of AI. Maybe it is time to book profits. Now, we have a trade on this. We bought the 130 calls. We sold the 135. So you got to manage this trade immediately on Monday. Book your profits. Don't be too greedy. Meta weekly chart. The expectations were, after this massive rally year to date, or since the bottom we should say, the stock is priced for perfection. And the report was anything but perfection. Sure, we have positive growth, but is it enough? Does it really justify the SPOP higher? The answer is no. But it's all about expectations, folks. The expectations were we're going to see negative growth. That didn't happen. So this week we saw a lot of short covering. And it got us all the way to the top target that I have, which is 328. We know the elevated RSI been here for a long time. We know this chart is due to pull back big. The higher it goes, the bigger the pullback. Now it's up to the managers. Are they going to take profits from Meta this week or not? If they do, then the assumption is we're going to see a sell-off in all of these technology names because Meta was the only one that's actually growing positively. If you look at trends, Microsoft Azure down, Google revenue down. Meta is the only one moving higher. If they sell Meta, they're going to be selling Google, they're going to be selling Amazon, they're going to be selling Microsoft. So keep an eye on this one. If it starts to move down, everything will move down with it. Here's the one that perhaps breaking down already, which is Microsoft weekly chart. Again, you saw the facts, Azure revenue down, but somehow we're trading at the same price as the top of 21. Doesn't make sense at all. The volume is moving higher on selling weeks. We have negative divergence in the RSI. We have MACD is about to become negative for the first time this year. All roads leading to a big pullback in Microsoft that could take us all the way down to, let's say, 300, and then we see what happens. That's the classic 10% pullback, by the way. Then we have NVIDIA 2 hours chart. What do we see here? Did not break the trend line this week. And the risk becomes, what if this pattern is of a cup and handle formation? And if that is the case, you can look at the options market yourself. They're buying a lot of 500 calls. Could it happen? The answer is yes. But folks, it's all up to the managers now. They got earnings from ASML. They got earnings from Lam Research. They got earnings from Taiwan. They got a lot of talk about AI from Microsoft, from Alphabet, soon enough from Amazon. They're going to put 2 and 2 together. And if they decide to sell NVIDIA, they'll sell NVIDIA. And the cup and handle is not going to play out. But understand this, NVIDIA is going to report late in August. So it's going to prove to be more steady than the others. Now, I have a question by the viewer on Discord that I did not respond to. It's about MO. It says MOS here, but it's MO, which is Altria. The name pays a high dividend of about 8%, so maybe this is why the viewer is interested in it. But look at the weekly chart. We're not out of the woods here. This could be a bear flag pattern, and down we go. Is it worth cashing 8% dividend if the stock goes down 10%? Right now, if we're going to chase dividend stocks, make sure that these companies are way oversold, such as Verizon, for example, such as AbbVie, and they did report earnings, and they did better than expectations. And I can name Verizon and AbbVie. But the problem with these dividend stocks, as rates go higher for T-bills or money market funds, it's not really worth it chasing these dividends in these names. And when we look at Philip Morris versus MO, they're both down for the year, but MO is outperforming Philip Morris. If we zoom out even more, Altria got a period of outperformance versus Philip Morris during the vaping mania, but that's over now. So when it comes to tobacco, I'd actually prefer PM versus MO. And then we have a question here. Thanks, Mav. Please cover Wing if you can. Been short for a while. It's finally paying off. Not sure if it is time to take profits. Seems like it still has quite a ways to fall though. Let's look at Wingstop. This is WING, a daily chart. This is what the viewer is talking about. Big pullback. And we see the chart oversold and we have earnings coming out. What do you do in this situation? I agree with you that we have more downside coming, but it's a strong company. What if the report comes out better than expectations and we see short covering and a big pop higher? You have to assume that. So what I would say is you got to hedge. You got to buy some call options here out of the money short term just in case we see Wing popping higher. But you look at the weekly chart, we have a steep trend line that has been broken now. And we know that this range of, let's say, 161 to 165 is an important zone. If it's broken, then we have more downside coming. The RSI is in negative divergence, so is the MACD, both suggesting that we have more downside coming. But in the meantime, you gotta hedge for the most immediate catalyst, which is earnings, and you never know what's gonna happen. We see stocks acting absolutely weird. The earnings by Boeing or Union Pacific, for example, were absolutely abysmal, but these charts shot up significantly higher anyways, so you gotta have your hedges ready. And the last one, hope you can do GEPI this weekend. Okay, this is from JP Morgan, and the attractiveness of this is it pays about 9.5%, higher than any T-bill, higher than the money market funds, but it is untested as a product. It has really good management. It has a strategy of buying heavily researched stocks at good valuations, and also using option strategies to write covered calls to raise cash. I don't have anything against it here, but it is untested. It's relatively new here. And what is the point of getting 9.5% if this goes down because the market goes down? I say if you like it, have a little bit of exposure, but understand this. If rates continue to go higher for longer, then you're going to see the 1 year at 5.5%, 6%, then maybe 6.5%, 7%. And then this product becomes less attractive because now you have risk-free for 1 year and it's paying you 6.5%. And maybe you should add to the 1 year incrementally as these rates go higher versus going with GEPI. It's not a bad product, but it has a lot to prove. Last but not least, the daily chart for Tulips Bitcoin. What do we see here? The answer is nothing to see. Support 29,200 is still intact. Until it's broken, then we're talking. Lastly, moving on to the conclusion of this video, what do we have in the economic calendar this week? Monday, we have Chicago Business Barometer, we have the Fed Sluice, and then Tuesday, August 1st, we have the manufacturing PMI, job openings, ISM manufacturing, and construction spending. All important indicators. And then Wednesday, the 2nd, we have the ADP report. Thursday, the 3rd, we have initial jobless claims, we have the services PMI, ISM services, and factory orders. And the most important day, Friday, the 4th, we have the non-farms. It's all about wages, folks. And with that, long video, but I hope you found it entertaining and most importantly, educational. If you did, you know the deal. Like, subscribe, leave a comment, join our membership program. But with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
Lloyd, why don't you roll your dice and let me roll my own?